going on right now as we record this are steps being taken to steal, really, those foreign currency reserves of Russia. They were frozen. With funding for the war in Ukraine, we've seen trial balloons floated, first by unnamed sources in the EU and in the US government, but now, as you know, Yellen has said this. Even Biden said this a couple weeks ago. He'd like to get some plan to access those funds before the next G7 meeting. So keep an eye on this. There's also a big threat to expand the war. This is all, and again, those are all things that we can sit here in middle of March and go, well, gold's broken out. Now we got to watch the Fed, all this kind of stuff. There's all stuff that might just go completely haywire by summertime and, send gold and silver soaring. So these are all things we got to be aware of and keep our eyes on.
The US dollar faces a looming financial crisis due to its unsustainable debt trap, shrinking bank credit, and escalating interest rates. This crisis is allegedly being exacerbated by Russia and China, who are accused of destabilizing the US dollar as the global currency. They are purportedly working towards introducing a new single, gold-backed trade settlement currency, potentially adopted by the enlarged BRICS membership. In response to Russia's invasion of Ukraine 2 years ago, the United Kingdom, a major gold broker with substantial reserves, ceased all imports of Russian gold. This move comes when Russia rapidly increases its gold production, poised to grow by 4% annually until 2026. Since 2013, Russia has been fortifying itself against Western sanctions, isolating its economy from transactions reliant on the US dollar. In early 2022, Russia pegged its currency, the ruble, to gold, intending to transition it from a pegged value to the gold standard. This strategic move was driven by the desire to establish the ruble as a reliable gold substitute at a fixed rate. The ongoing Russia-Ukraine crisis and subsequent US sanctions against Russia have accelerated discussions around introducing a gold-backed currency. Renowned analyst Craig Hemke, host of Sprott Money, asserts that recent geopolitical events, particularly during the Ukraine conflict, underscore the potential risks of solely relying on the US financial system. The US freezing Russia's foreign currency reserves and excluding it from SWIFT have significant ramifications. Even nations traditionally aligned with the US may be compelled to safeguard their interests amidst the shifting geopolitical currents. Hemke's anticipation of such geopolitical maneuvers, including discussions surrounding accessing Russia's frozen reserves to fund Ukraine, underscores a notable shift in the global financial landscape. This move, coupled with threats of expanding the conflict, underscores the volatility and uncertainty in financial markets, potentially reshaping the dynamics of assets like gold and silver in unforeseen ways. We will present clips from Craig Hemke's interview with Commodity Culture. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
There are a lot of smart people that think that, and again, it would make sense, right? If you want to offer an alternative trade settlement currency, on that side of the world primarily, away from the dollar and, the hegemonic stuff that the US does with it. You got to give it some kind of confidence. You just can't use the yuan. You can't just use the ruble. And so just like how the dollar became the reserve currency after World War II, because the U.S. had all the gold and a functioning economy, so it's backed by gold. Okay, hey, we'll use the dollar. Okay, I feel good about it. The BRICS would probably do something like that. What I think people need to be cautious of, and I've said this for a long time, is this is not like a binary flipping of a switch, where they announce they're going to start using something or make it available. That doesn't mean immediately the dollar's dead, It's not that simple. Think of it, though, in these simple terms as just a reduction of demand for the dollar. The dollar, no different from any other good. Oranges, homes, whatever. You've got the supply curve and the demand curve. They teach you that in Econ 101. And where they intersect, that's price. And as you move the curves, you move the price. Okay, so in a world where we're constantly increasing the supply of dollars, could also be a world where the world's demand for dollars is falling. So again, apples. If you've got more apples and less demand for apples, the price of apples is going to go down. And so think of that's how this impacts the dollar. And then, how does that impact spending power, inflation, commodities, everything else? So that's the first thing on that. The other thing, though, gets back to this bigger picture, again, the hegemon, the biggest thing that happened, at least for now, in the Ukraine war was the first weekend of March in 2022 when the U.S. froze Russia's foreign currency reserves that weren't held within Russia, about $300 to $400 billion worth. But then also kicked Russia out of SWIFT. I mean, how does that not get noticed by anybody that, you may not look at yourself as an adversarial country to the U.S., but you might see a point in the future where the U.S. is going to frown upon you looking out for your own best interests. So now there's interest in, well, maybe we ought to set up our own deal over here. Going on right now as we record this are steps being taken to steal, really, those foreign currency reserves of Russia. They were frozen. With funding for the war in Ukraine, we've seen trial balloons floated, first by unnamed sources in the EU and in the U.S. government. But now, as Yellen has said this, even Biden said this a couple weeks ago. He'd like to get some plan to access those funds, before the next G7 meeting. So what just came out, we're recording this on the 13th, I saw headlines today. They're going to take the interest that Russia is earning in those parked frozen funds and give the interest to Ukraine. Just going to give the interest and earning, whatever that is, and give it to Ukraine because Ukraine's run out of money and the political will in the U.S. to keep, just giving them these blank checks. That's not good for continuation of the current system. Again, get sideways with the U.S. We're going to take your money. We're going to freeze you out of our system. Okay, I think I'll use this other system now. So keep an eye on this. There's also a big threat to expand the war. The actual kinetic living, fighting, and dying part. So this is all, and again, those are all things that we can sit here in middle of March and go, well, gold's broken out. Now we got to watch the Fed, all this kind of stuff. There's all stuff that might just go completely haywire by summertime and, send gold and silver soaring. So these are all things we got to be aware of and keep our eyes on.
Gold's resurgence continues as mounting investor interest is propelled by persistent inflation and the lingering effects of elevated interest rates. This heightened attention often triggers a flurry of headlines and news coverage, typically resulting in a rally of around 8 to 10%, signaling a notable surge in market activity. Last year, gold carried lofty expectations, with hopes of reaching $2,300 remaining unmet. However, the anticipation for a breakout persisted into the current year, and as expected, a breakout did occur, followed by a subsequent rally. Investor confidence in gold's safety and stability strengthened, evident in its price reaching an all-time high of $2,202.39 this month. Looking ahead, Craig predicts that the sustainability of this momentum towards $2,300 and beyond will heavily rely on macroeconomic conditions and the Federal Reserve's actions. Meanwhile, silver is trading within a range of $22 to $28. To elicit a significant market reaction, it must surpass $28. The recent uptick in silver prices has been primarily driven by short covering, with hedge funds transitioning from net short positions to adding long positions, propelling silver to around $25.50. However, Craig predicts that for silver to exceed $28, it must first breach the $26 mark. Let's get back to the interview.
In my forecast for 2023, I thought that by the end of the year, recession to be pretty clear to everybody and liquidity be tightening up and the Fed would have to start cutting rates and that sort of thing. And so I thought gold would break out. It's been a very well-defined range for about 3 years. And usually when anything breaks out, it's clear, especially when it's been going on for that long, it's pretty clear to all the market participants what's going on. So then you get this rush of headlines and news and, people, hey, look at that, it's breaking out, I should get in. And then that generally results in some kind of rally, 8, 10%. And then we see what happens after that. So anyway, last year I thought we'd get to 2,300. Obviously we didn't, but I repeated that this year. I said, okay, I still think that breakout's coming. And then you get this follow-on rally after that. And that's what's happened. Now, once gold, if you go back to the 1st of March, because Jesse, I still see a lot of people say, well, I don't know why gold suddenly took off. It was a little bit of what I just described. Back at the last day of February was the latest PCE report, in the US on inflation, and gold ticked up about $12 that day. And it was up another $10 on Friday, the 1st of March, when one of the Fed goons, Goon Waller, came out and gave a speech detailing where he thinks monetary policy should go from here. And he said a couple of things. He said, well, I think we should do kind of a quantitative tightening, Operation Twist thing, where we liquidate some of the long end and buy the short end. Well, that would have the impact of uninverting the yield curve. And usually a recession follows that when the yield curve uninverts. So it's like, okay, that might cause a recession. But then he also said something very important. He said, if we do that, that'll give us room the next time we need to do an asset purchase program to buy on the long end. And that's when everybody went, wait a second, hold on. He just said there will be more QE eventually. Gold shot $30 higher that day, Friday the 1st, from that point. Closed at daily all-time high and a weekly all-time high, about 2090, something like that, 2095. And then here came that rush of money that I mentioned. You make that new all-time high. And so the very next week, that first week of March, from the 3rd to the 8th, gold was up like $97. Open interest in COMEX gold expanded by 25% as all this rush of new spec money came in. We went to 2,200. So what's that? 5% rally, not the 8 or 10 yet. And now we're kind of trying to find our way forward. So that's what happened. How much we have legs to 2,300 and then beyond as we move into the summertime will kind of depend on the macro conditions and what the Fed does. And my forecast for silver this year was that it wasn't going to break out. And it hasn't yet. Again, it's in the same type of box that gold used to be. The day will come when it breaks out. I mean, gold's not going to 2,500 and you're going to have a gold-silver ratio of 100 to 1. And silver is going to stay at 25. Even if, if gold gets to 2,500, I don't know, later this year, next year at some point, you had an 80 for a gold-silver ratio. Well, that's 31. Okay, so that gets you out and broken. And the same thing will eventually happen in silver that we just went through with gold. If you want silver to go in the extension of the mining shares, you got to get silver to break out. And it's got to get above 28 and then a 3 handle, and then it'll probably go to 35. But it's got to get to 26 first, and it's not even there. So I'm unfortunately, we're going to continue to be frustrated by it a little bit. But fortunately, and I say this as someone who is still holding silver that I bought like in 2010, we probably have to wait a little bit longer for it to get the kind of explosive move we just saw in gold.
In 2024, gold has broken historical records, trading above $2,160 per troy ounce. This surge is fueled by its demand as a protective asset amid global tensions. Recent events, like the UK's halt of Russian gold imports and Russia's move to tie the ruble to gold, signal a shift from reliance on the US dollar. These developments hint at significant changes in the global financial landscape, affecting assets such as gold and silver. We would love your thoughts on Craig's predictions in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.